When people hear the phrase stock market, they usually imagine something cold. Screens, algorithms, numbers flashing up and down. It feels abstract, almost mechanical. But stock market didn't begin as machines. They began as human response to fear. Fear of loss, fear of uncertainty, fear of betting everything on a single outcome. Long before finance became technical, people faced a simple problem. Some projects were too big for one person to fund alone. Ships needed to be built, trade routes needed to be financed, mines needed capital, and failure was common. A storm could sink a ship, pirates could steal cargo, returns could take years or never arrive at all. So people did something radical. They shared the risk. That idea, more than any spreadsheet or model, is where stock exchanges truly begin. Let's go back more than 400 years. In the early 1600s, the Netherlands was one of the world's greatest trading powers. Dutch merchants were sending ships thousands of miles away, particularly to Asia. These voyages were expensive, slow, and dangerous. No single merchant wanted to risk everything on one expedition, so the Dutch East India Company introduced something revolutionary: ownership. Not a loan, not interest, ownership. People could buy shares in the company and receive a portion of future profits. But the truly radical idea came next. Those shares could be sold to someone else. Ownership was no longer permanent, it became transferable, and the moment ownership became tradable, a market was born. People began meeting in Amsterdam to buy and sell these shares. There was no exchange building at first, just people, paper certificates, and trust. Trust that profits would be shared, trust that records were honest, trust that ownership meant something. This is widely recognized as the first modern stock exchange. Now, pause for a moment and appreciate the scale of what began there. What started as a handful of ships and paper certificates eventually became something enormous. Today, global public stock markets are worth roughly $100 trillion. That figure represents ownership in companies across the world: factories, banks, technology platforms, energy producers, consumer brands, you name it. All of it traces back to one simple idea: tradable ownership. From Amsterdam, the idea traveled. Now let's move to London. London's stock market didn't begin in a grand building. It began in a coffee house. In 1696, Jonathan's Coffee House became a gathering place for merchants, ship owners, and investors. People came not just to trade, but to talk. Which ships had arrived, which were delayed, which ventures were struggling. Information mattered more than speed. News traveled by word of mouth, and gossip was data. Over time, people began trading shares in these coffee houses. Deals were struck over cups of coffee. Reputation mattered enormously. If you honored your word, people traded with you. If you didn't, you were simply excluded. Eventually, this informal system became organized, and that organization became the London Stock Exchange. London grew alongside the British Empire. It financed railways across Britain, canals that powered industry, mines and companies across continents. London became international not by design, but by circumstance. Empire meant global trade. Global trade meant global capital. That legacy still shapes London today. Many companies listed in London earn most of their revenues outside the UK. London didn't just finance Britain, it financed the world. Now let's cross the Atlantic. The New York Stock Exchange also began informally. In 1792, traders met under a buttonwood tree on Wall Street. They signed an agreement to trade securities with one another and charge standard commissions. That simple agreement became the foundation of the New York Stock Exchange. America at the time was young, but it was ambitious. Railroads needed vast amount of capital, steel companies needed funding, oil companies needed investors to take risk. The US stock market grew around scale and growth. One language, one currency, one legal system. Capital could move freely across states. That mattered more than people realize, actually. Over time, New York became the deepest and most liquid stock market in the world. Then something new emerged: Nasdaq. Founded in the 1970s, Nasdaq was electronic from the start. No trading pit, no shouting, no hand signals. Orders were matched by computers. At first, traditional traders dismissed it. They believed real markets needed physical presence. They were wrong. Nasdaq attracted companies that didn't fit old definitions. Technology firms, biotech companies, software platforms. This is why Nasdaq still feels different today. Its culture is rooted in innovation rather than tradition. For a long time, stock exchanges looked nothing like they do today. There were no screens, no charts, no quiet rooms. There was the trading pit. If you walked onto the floor of the New York Stock Exchange 50 years ago, it would feel chaotic. Traders stood shoulder to shoulder. They shouted prices. They gestured wildly. This wasn't noise for its own sake. Prices were discovered through human interaction. Who needed to sell urgently? Who was willing to buy? Who had confidence? But the pit had limits. Only so many people could trade. Only so many deals could happen. Technology changed that. Electronic trading removed geography. Capital could move instantly across borders. Liquidity increased, costs fell, participation widened. The pits disappeared. What replaced them was quieter, faster, and far more complex. Now let's go east. Japan deserves its own chapter. After the Second World War, Japan had to rebuild almost everything: its economy, its industries, and its financial system. The Tokyo Stock Exchange became central to that rebuilding process. Japanese companies were built differently. Long-term relationships mattered more than short-term profits. Banks, manufacturers, suppliers were often tied together through cross-shareholdings. These structures were known as keiretsu. In the late 1980s, Japan became the largest stock market in the world. At its peak, Japanese equities represented over 40% of global market value. Then the bubble burst. Prices collapsed, but Japan's market didn't disappear. Today, it remains one of the largest stock markets globally. That tells you something important. Markets can fall, but institutions endure. Across the rest of the Asia, markets developed for different reasons. Hong Kong became a bridge between global capital and China. India's markets expanded through domestic participation. China's exchanges were designed to serve national priorities, not just shareholders. Emerging markets across the world followed similar paths. Their exchanges may be smaller, but they finance local growth and ambition. Now zoom out one final time. When people say the stock market, they are really talking about a global system spread across dozens of exchanges. Some markets dominate today, others dominated in the past, others will dominate in the future. Stock exchanges are not machines, they are human institutions, built slowly, shaped by trust, influenced by culture. They exist for one enduring reason: to share risk. That is the thread that runs from ships in Amsterdam to coffee houses in London to buttonwood trees in New York to electronic markets today. The form has changed, the purpose hasn't. Once you understand that, investing becomes much calmer. You stop reacting to noise, you start understanding systems. If this helped you better understand how markets came to be, please do feel free to subscribe, and I'll see you in the next video. All the best.